What's going on, everyone? It's Nick with Us versus Herd, kicking off the live stream. It's been a minute, but we're going to get back into the regular content. Happy to be here. Thought today would be a good day to kick this thing off. I probably sound a little bit nasally. I am battling a cold right now, but yeah, it feels good. It feels good to be here. It feels good to be back. If you're in the chat right now, say what's up. What's going on, Chase and Ben? How you doing? But, before we get things going, kind of what we're anticipating today, Fed monetary policy, of course, they're going to be releasing the minutes in roughly 20 minutes. We're going to go over that. Then Powell's going to have a speech, so we're going to watch Powell's speech. So, we're going to see how the market reacts, kind of what the deal is now, and what to kind of expect, because this is definitely going to be historic in a lot of ways. First of all, because they're attempting to raise rates during a potential economic downturn and high inflation, which has never been done before. Also, they're looking to have potentially a quantitative tightening schedule, right? So as we get started here, kind of want to do a brief history lesson for those that kind of are not familiar with, what's going on, why it's important, why are we doing this, why does this matter, does it matter, does it not matter, So let me pull some up for you. So starting in July of 2007, the Fed created a credit and liquidity program to deal with the 2007-2008 financial crisis, which worked. They saved the banks, saved the people. I mean, we still went into a great recession, as they call it, but they saved it from us going into probably a potential depression. So they called it a win, right? It's like, hey, at least we didn't go into a depression. Everything was good. So as you can see here, what I'm highlighting here on the screen is the Fed's balance sheet over time. And again, I said this starts at, you can look it up yourself. This is at federalreserve.gov. So I'm not making this up. This is not some Illuminati website or anything weird, right? This is the federalreserve.gov, the government website, which is public to everybody. So as of March 9th, right, 2022 is how far the data goes. So they're running roughly about a week behind in terms of their data and getting it to us. But this is kind of what it looks like. And as you can see, we're in kind of a mess right now, right? We're in high inflation. I said this when I was live streaming and we were talking about the 2020 pandemic, because they were just printing, getting stimulus to everybody. And I mean, I'm not saying that the stimulus was bad, but I do know for a fact that a lot of the stimulus went to people that did not need it. Upper to middle class people did not need the stimulus. They got it, just went to their savings account. When things opened up, they just went on vacation, spent the money, right? So that's kind of how the transfer of wealth went from the stimulus checks into the top 1%, like Amazon's or Microsoft, because people spent the money. But regardless of that, as you can see here, we had a sharp increase, and over the last year, they have not stopped. I think the problem with this, the problem that I see, and the problem that I've always seen with this credit and liquidity program, was that they were basically using it like a credit card to print more money to stabilize the markets. Now, we didn't need this before 2007. We didn't need it. But in 2007, something happened in terms of the potential financial collapse of America, that we need this now. But the problem is they didn't dismantle it. They kept it going, and they kept printing and kept printing and kept printing. And now we're in a place where we have high inflation, and they're like, well, why don't they just stop, right? Why don't they stop? Why don't they stop printing money? Why don't they stop supporting the markets, right? And there was a period of time, since let's say it was 2014 through 2018, they were not. But what happened to the market during 2014 and 2018? We were kind of flat. The market did go up after Trump announced that we were going to have the corporate tax cuts. That was the catalyst to break us out. The Fed did not do a single thing to help that run in 2017. 2017 we were ripping up, but that was because Trump passed the corporate tax rates, or corporate tax cuts, I mean. So because remember in 2017, I'll pull some charts here in a minute. I just kind of want to go through what's happening right now and where we're at, right? So Fed wasn't supporting and everything was fine, but however, we plateaued and Trump was like, hey, I need a win. I need the stock market to do well. Okay, corporate tax cuts. Let's make the market rip, and that's what made the market rip. Then they're like, okay, well, in 2018, Janet Yellen and all our friends were like, you know what? Maybe we just don't need it. We don't need this. So they started a quantitative tightening policy. And if you don't know what a quantitative tightening policy, which they're going to be talking about it today, hopefully, is called QT, in abbreviation, is a monetary policy applied by a central bank to decrease the amount of liquidity within the economy. The policy is the reverse of quantitative easing, aimed to increase money supply in order to stimulate the economy. So as you can see, we have been, since 2019, we've been on a non-stop QE or quantitative easing type of scenario, type of plan from the market. And the question is like, hey, after 2020 and 2021, why didn't they stop? Why are they continuing this over the last year, over the last 6 months? Why are they continuing to do this? I mean, and you're like, hey, why, if you're like, well, what are they holding? You could actually see here, if you look selected assets of the Federal Reserve, securities held outright in millions of dollars. So they're buying stocks, bonds, ETFs, and they're holding them just like a regular person, right? And this thing has skyrocketed over the last year. They just kind of been maintaining, but we're just ripping here. They just kept buying and buying and buying. So the market that we're in has been extremely artificial, extremely just supported by the Fed. Without the Fed, the market would, probably crash. And that's what they're trying to do. The thing is, we didn't need this before 2007. And there's definitely a lot of things going on in the world today in terms of world powers such as China, Russia, Ukraine, what's happening to the dollar, what's happening to the ruble, what's happening to the yuan, what's happening to all of this. And all of this is a great balancing act that the Fed is trying to balance, right? And you're like, okay, well, why don't they stop? Well, in 2018, they started to trim through 2019, and we actually, in 2018, closed the market red for the first time in 5 years. Crashed the market, right? So that is what they're trying to avoid. But right now we have high inflation. The market's already going down. I mean, Nasdaq already corrected 20%. Dow and S&P are down 10% to 15%. I mean, it's not, we're in a bad situation. But the question is, like, as an American, as a person that cares about this, watches this, and, trades in the stock market every single day for the most part, like, how do we get out of this? And at this point, the Fed is between a rock and a hard place. They have to raise rates to curb inflation. They have to do some things here, because if they don't, I mean, high inflation and a crashing market, I mean, we're going to go to a depression, right? So I don't know if they're going to announce anything in terms of QT today, but they're expected to raise 0.25% rates and give us some sort of timeline where they're going to give 0.25%, over time, another additional 0.25% or whatever they want to do. So I guess we'll find that out in about 10 minutes, right, where they're releasing the minutes. I mean, the market today has been reacting fairly positive, right? If you're here right now, say what's up, Jeff. What's going on, Trader K? What's going on, everybody? Hit the like button if you guys can. I just wanted to give you guys that intro of why this is important. But I mean, as you guys can see here, I mean, looking at the Nasdaq here, I mean, we ripped all last year, and the Fed was buying all year, right? And I don't think they needed to. But the Fed was scared that, due to the pandemic, but I don't know why they wouldn't stop, because, I mean, all these companies were posting record profits, home runs. I mean, in a way, it's kind of disgusting, right? It's kind of disgusting what they did. And now, instead of trying to tighten last year, They're now trying to tighten when we had a huge decline, right? If we look at the S&Ps, I mean, the S&Ps are not that bad, but we did death cross. I mean, we're under the 200-day moving average or under the 50-day moving average. I mean, in the long run, not a big deal, right? I mean, if we're looking over the last 5 years, not a big deal. I mean, not too concerned if you've been investing, you've been holding for 5, 20, 30 years, not a big deal. Is it a big deal if you were trying to retire this year or last year or whatever? Yeah, it's a big deal, right? But I mean, in the big scheme of things, I mean, not a big deal that we're having a down move, right? I mean, we were kind of all expecting. I mean, when we have a run like this, you just can't expect it to go on forever. And if you kind of match up, this run here with the balance sheet, I mean, it kind of makes a lot of sense. Daniel, what's going on? I mean, if you match up the run with the balance sheet, it makes sense what happened. It wasn't the good people of the United States supporting this, that was the Fed. And why they kept printing, I don't know, man. But that's where we're at. So, I mean, in the long scheme of things, not that bad. I mean, if we see S&Ps come back down to 3,000, I would definitely start getting concerned. And everyone's kind of freaking out. There's no way this could happen. Don't say never. You never know. I mean, we've never been in this position where they're trying to raise rates and tighten in a down move like this. I mean, we're just I know I'm ranting, but I'm trying to give you guys my opinions and obviously kind of my thoughts behind what's happening today. What's going on, Adele? How we doing? As we wait here. So yeah, if you guys are just joining, we'll be going over the minutes here in just a few minutes of the Fed, and then we're going to be live streaming the Powell speech, kind of hang out, just giving some context behind some of the trades that we're looking at. I mean, I would say, I think for me personally, obviously what has been the biggest adjustment for me in this market has been the volatility, where we're just, hitting a range of points. I mean, today we're up 1%, right, on the S&P. But I mean, if you look at like a weekly range, like over the last couple of days, I mean, we're pinging back and forth 200 points, right? 200, 300 points. I mean, this is crazy. I mean, if you look at Nasdaq, we're pinging 1,000 points back and forth, 2,000 points back and forth, 1,000 up, 1,000 down, 1,000 up. I mean, it's crazy. So the volatility with low liquidity, I mean, it's crazy. And then we have the mess in Ukraine, where the U.S. is not directly involved, but are directly involved in terms of the war that we're waging against Russia, an economical war, right? We're not necessarily waging a military war yet. Hopefully we don't, but we did raise an economic war against Russia and along with Russia allies, right? So far, not really China, but if the U.S. has made threats to China that if the U.S., I mean, if China helps Russia to avoid sanctions and stuff, there's going to be retaliation, sanctions against China and stuff like that. And this whole thing, I mean, after the pandemic and after everything that has happened in the world, I mean, honestly, it makes sense on why this would come to a head, because I mean, for a long time, for many decades, right, China has been edging out the United States as a top world power, where China was way down on the list. Then China came to number 2 in. When you're number 2, what are you gunning for? Number 1. And the U.S. has been doing nothing but, not helping itself. Let's just say it that much. We don't make anything. We don't export anything. We get everything from Asia or the Middle East. I mean, we're kind of a fat, disgusting country that just cares about profits, and that's about it. But we actually don't do anything. We don't do anything. So, take it as you want. I mean, some people might not like that statement, but, I kind of think it is what it is. I mean, a lot of people are lazy these days. Not a lot of entrepreneurs out there. If you're not creating businesses and you're not out there, if you'd rather, a lot of people just want to play it safe, work in a cubicle, get their 401ks, But that's not America. That's not what America was built on, right? America, and right now there's a pretty big wealth transfer going on in America, right? There's a pretty, and that's why you start seeing things like, why do people hate billionaires so much nowadays? They didn't used to 10 years ago, right? Or 20 years ago. What happened when Anonymous came out and it was against Wall Street? That wasn't a thing before, right? Why is all this stuff happening? Because the divide between classes is getting larger and larger and larger. We're the 1% in the middle class, where the middle class and the lower class are kind of merging, and the 1% is going way up, right? And that's why people are mad, is because the barrier to entry has gotten higher. To become a millionaire today, the barrier to entry is higher. Matt, what's going on? So, these, of course, are my opinions. This is kind of how I view things. But, we've known for a long time, since the financial crisis, when they started this process, that America was not in good financial health. We are not in good shape, where greed from the banks killed everybody else. And everybody, a lot of people lost their homes. But who was saved? Wall Street was saved. The banks were saved. The JP Morgans, Bank of Americas, right? Those people were saved. However, people like me, we lost our house. We were unemployed, right? What happened during the pandemic, right? Pandemic, same thing. A lot of people were unemployed. People lost their homes, foreclosures. They had to freeze those. They had to freeze rent. Then they started printing stimulus. Where'd that stimulus money go? Stimulus money went back to the 1% because we had to buy stuff that they own. Rinse and repeat, right? So that's how they got richer. And that's why, the Jeff Bezos got so much more money during 2021, is because all the money that the Fed printed, they took in because we all spent it. And that's why a lot of people don't have savings anymore. They spent all the money that they needed to live, and people like Amazon took it. Sure, you didn't get, they didn't put a gun to your head, but that's where the money went. People instead of investing in school or in themselves, they bought TVs, they bought cars. I know I'm ranting, but it's frustrating, because from my end, as like an entrepreneur, people that I've started businesses, multiple businesses, and trading. And if you're trading, you own a business. Trading is not a hobby to me. Trading is a business, right? When you're investing or trading in the market, that's a business decision that you're making for yourself. You make money or lose money, like you do in any business. You make a bad decision in business, you lose money. You make a good decision in business, you make money. Same with trading, right? It's a financial transaction. All right, these minutes about to come out. Let's see what happens. But what are you going to do? We're along for the ride, whether we like it or not. But I just kind of wish, personally, I wish they would just. I don't want them to see a market crash. I don't want to see people lose jobs. But I don't want them to be printing unlimited money supporting it, because that's not sustainable. I'd rather go through some hardship and get started out on the right foot. I don't know if you guys agree with me. I'd rather go through some hardship. Looks like the market's starting to react a little bit. Minutes just popped out, but I'm waiting for an update here. I'd rather go through some hardship to get on the right financial stepping and foot ground, than to keep doing what we're doing. All right, let's see what's popping with these minutes. So I'm waiting for the update. But I mean, so far market reaction doesn't look bad. I mean, we were also very conditioned for 0.25%. Okay, let's get this article over here. Okay. So Fed approves first rate hike in more than 3 years. Sees 6 more ahead. So we have at least 6. So they did raise it after keeping its benchmark anchored near zero since the beginning of the COVID pandemic. The policymaking Federal Open Market Committee said it will raise rates by a 0.25 percentage point, which we were expecting, 25 basis points, bring the new rate to 0.25 to 0.5. The move will correspond with a hike in the prime rate and immediately send financing costs higher for many forms of consumer borrowing and credit. Along with the rate hikes, the committee also penciled in rate hikes in each of the 6 meetings this year, pointing to a consensus funds of 1.9% by year's end. So by the end of this year, rates should be at 1.9%. And right now we're at 0.5. Okay? The rate hike was approved with only one dissent. St. Louis Fed President James Bullard wanted a 50-point basis. Yeah, I mean, I don't know if you guys noticed, like, over the last month or so, Bullard, like, he wanted, like, he's like, let's do 100 basis points. Let's just rip it off. I mean, I kind of agree with Bullard. Let's just, let's grow some balls and do this. Like, come on. Committee last raised rates December 2018. And then they started the QT policy, and the market went, which we're already imploding. But, who knows? In its post-meeting statement, the FOMC said it anticipates ongoing increases in the target range will be appropriate, addressing the Fed's nearly $9 trillion balance sheet, which we kind of just reviewed, comprised mainly of Treasury and mortgage-backed securities it has purchased over the years. The statement said, in addition, the committee expects to begin reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities at a coming meeting. So no schedule right now for QT, but it's coming. It's coming. Along with the rate increase, committee members raised their outlook for expected rate hikes through the end of the year and adjusted their outlook for inflation, unemployment, and overall economic growth as measured by gross domestic product. Man, sorry, I'm a little sick, so I'm not well. The central bank has slashed its Federal Reserve funds in the early days of the pandemic to combat a shutdown. Okay, we kind of already got that. Here we go. The current trend of price increases at their fastest 12-month pace in 40 years has been fed by demand that has far outstripped supply chains because they printed too much money. We kept buying too much crap. That's what happened. Unprecedented levels of fiscal and monetary policy. Yeah. Unprecedented levels of fiscal and monetary stimulus, which we covered just a little bit ago, was, I can't right now. More than $10 trillion worth have coincided with the inflation surge, and the Ukraine war has coincided with a major spike in oil prices. And just so you guys are aware, if people are like, hey, we should go to war or something like that, like, war is not good for inflation. Look it up. Look up what inflation has done in past years. It's not good. It's not good. War and inflation go hand in hand. Okay, it's going to make the problems worse. Also going to make our spending problems worse, because if we spend more money, if we're at war, we're going to be printing more money to support our military. Also, not good. Printing, just so you guys, I think the theme is here, printing money is not good. All right, take care, Matt. So, you know, I think that we're in a tough spot. We're in a tough situation. Market's kind of going down a little bit. I mean, we're still green on the day, but we could potentially close red. I actually didn't do any trades today just because I wanted to. I didn't feel right about trading today, knowing this is going to be the first rate increase. I mean, we kind of knew how the market was going to react, but at the same time, I don't want to put my capital at risk today. I made enough money this week already. I don't need to trade today. You don't need to trade. People, we kind of act like we need to trade. We don't always need to trade. So I'm gonna be kind of covering the markets here for a little bit, and then I'm gonna be live streaming. I'm gonna wait for Powell to come on, which is gonna be interesting. Like, I mean, if you're trading right now, I definitely would be careful, and the market is gonna hang on every word that Powell says today. So I really hope he sticks to the script and doesn't go off script, and he really practiced his speech today, because the market, the people are going to be listening. I'm going to be listening. You're going to be listening. Everybody's going to be listening. The algos are going to be listening. Right now, VIX is moving up. Let's see if there's any updates here. I mean, I guess the good news is there hasn't been any surprise rate hikes, and Powell did say this. He said that there will be no surprise rate hikes, right? Let's see here. Let's see what ES is doing. S&Ps. Yeah, I mean, we had a nice bull, kind of a bullish pennant come out today, but then we were waiting. The market was waiting on the Fed. And, ever since about probably an hour ago, we started moving down. Like, everybody, I don't know, people just started bailing. And it doesn't seem like it's getting better right now. I mean, we're not moving that fast here, but I would still be careful. I mean, I wouldn't trade during the Powell speech, that's for sure. I mean, now that we kind of know what to expect. And I think, the one thing that I will say about Powell is that he is predictable. He tells it like it is, and he doesn't go off plan, and doesn't go off script. Now, the other thing that we do know about Powell is that he moves very slow, right? They waited till we had 8% inflation for their first rate increase. Think about how slow he moved. He saw 2% go by, 3% go by, 4% go by, 5% go by, 7% go by. We're at 8%. Makes you think, do we have the right people making the right decisions? Would you make anything? Would you make a different decision? I mean, I know there's a lot more to factor in. Like, as a trader, we're very biased, right? And it's a lot of pressure. I can't imagine the amount of pressure that he's under to make these decisions. But if you I'm just saying, if you let 3% go by, 4% go by, 5% go by, 6% go by, 7% go by, and wait till we're at 7.9% inflation to raise rates, at what point were you going to do anything? I just really think that the government is too reactive. They're not planning our future. They're reacting to what's happening or what has happened. They're not forward looking. They're not looking towards our future. If they're not looking towards our future, then who's looking out for us? Who's looking out for you? Who's looking out for me? I mean, we can look out for ourselves, but as a country, I think it's safe to say I don't feel like somebody is preparing us for our future, for our kids, for our grandkids. I don't see it. I don't think people they're just reacting to what's happening today. And sure, unemployment's low. And that's a great thing. But while the market was ripping and they were not responsible, just printing money, we had low unemployment. I mean, we've had it for all 2021. I just don't understand. I just don't understand what it would take for some people in power in the government to, I mean, I'm not the smartest guy in the world, right? I'm not pretending to be, and there's probably some things that I'm ignorant to for the decisions that they made, right? Obviously, they know things that we don't. I just don't, I mean, if they could explain it, maybe if they could explain it better why they didn't make the decision. But then even Powell came out a couple weeks ago, he said, oh, we probably moved too slow. And Janet Yellen even said after the 2018, a year later after they tried to do QT, she said, oh, we made a mistake. We shouldn't have done that. And they're so scared to disrupt the market that they're willing to sacrifice everybody else. I think that's the frustrating part. That's the frustrating part. They're willing to sacrifice everybody else for Wall Street, for the market. I mean, we have under 4% unemployment. What more do you want? What more do they want for them to start, trying to plan the future? That's all we're asking. All we're asking is to plan the future. We know what's happening right now. But yeah, Dow just went negative. Like I said, I'm not going to be surprised this closed red. Because, I mean, think about this. Think about this. I mean, if you're looking at the markets, right? And we looked at it, if through QE it makes the market go like this, and if they pull back, I mean, let's pull some charts from 2018 while we're waiting for Powell, right? I mean, what do you think this is here? This is all the Fed buying, and if we go back to 2018, let's go back 5 years here. All right, so let's go back. This is back in, like, we'll go back to here. I mean, it looks very similar here. This is when they started to raise rates and started QT, right? S&Ps went from basically 2,900, 3,000, let's just call it 2,900, all the way down to 2,300. And that's when the market was up. Now they're trying to do that while the market was down. I mean, the market was up. Oh, moved a little bit. So this was the market ahead of, this is when we, cratered based on QT. So, I mean, what kind of market, what kind of country are we in if we need the Federal Reserve to support the stock market? I mean, that's like the Bank of Japan. Bank of Japan owns 80% of the stocks. And you know what? Japan is a zero growth economy and has been for decades. Is that what we want? Is that what they're achieving? Is that what they want to do? I mean, just because they're rich? All I know is we're in for some very hard times. To be fair, we've had it easy. I mean, I'm 36 now. I've had an easy life. No wars. I mean, we had the recession. That was hard. But, I mean, in our lifetime, we really haven't gone, as an American, we haven't gone through many hardships. I mean, what our grandparents used to talk about, like, the Great Depression and World War II and all this stuff, and this is how things used to be. And we always thought like, oh no, that's in the past. Just because the photos are grayed out and black and white, that could never happen. But today it's happening. It's happening. And it's frustrating that I think it's just frustrating to me how irresponsible it was for them to continue to print money all through 2021 when we didn't need it. I think that's what makes me the most angry. Because through 2021, they balloon this. I mean, this is the biggest. I mean, this is how many is that? That's almost 1 trillion, almost 2 trillion here. It's almost at 9 trillion right here. $9 trillion, right? It's at 9 trillion. I mean, to get us out of the financial crisis, they only had to print 2 trillion, right? They printed 2 trillion to get us out of the financial crisis. They printed 2 trillion in 2021 alone, and we were not in a financial crisis. Why? I think that's what makes me the most mad. I mean, not that they got us out of the pandemic. That through 2021 was the most irresponsible year for our country. And now we're going to pay for it. And we all knew we were going to pay for it. Everybody knows. I mean, why do you think Jeff Bezos and Elon Musk and Mark Zuckerberg and all the elites were selling tons of stock in 2021? Why do you think they were buying real estate? I'm just saying. I mean, I'm not tinfoil hat kind of guy. I mean, I'm just stating the facts. This is not by accident. Why would Bill Gates be buying up all the farmland in America? Why would Jeff Bezos and Mark Zuckerberg be buying islands worth in Hawaii? Hundreds of acres. Why would they sell their stock? I'm just saying, guys, like, this is serious stuff that we have to think about. And the question is like, as Americans, as our generation gets older and starts coming into position of power, what are we going to do? We know what these guys are doing. What are we going to do? Because as soon as you know it, we're all going to be 40, 50, 60, 70s. We're going to be in these positions of power. And apparently you could be president when you're 80 years old now. What are we going to do with it? What do you guys think? I'll let you guys answer in the chat. I know I've just been I've had a lot on my mind, and I haven't live streamed in a while, and I'm just stating what I thought or think. Because it gets very frustrating to me. You know, as we wait for Paul's going to be on in like 12 minutes. What do you guys think here? I'm going to try to find the YouTube channel for him. Let's see here. Yeah, answer. I'm watching the Discord chat too. James, let's make oldest you can be president 60. Yeah, I mean, there's gotta be like, you know, and don't get me started about like, you know, the insider trading and Nancy Pelosi and all of that. Like, just don't get me started on it. President's going to be 90 years old. You underestimate how long they'll hold on to power. Yeah, I mean, I think one of the things that scared me the most, and, you know, I'm honestly, at this point, I'm not Democrat or Republican, right? I'm for America. I'm for the well-being of us. Politics, I don't know what side I agree with anymore, okay? Because both sides have screwed up real bad. But I think the scariest thing, remember when Trump posted this video on Twitter, which was like, you know, his empire, his legacy was like, it was like, you know, this train coming. It was Trump 2020, Trump 2024, 2028, 2020, 2032, and it kept going, and it was going, and then it said Trump forever. I think that scared me the most in terms of like, why would a sitting American president do that? Because that's very dictatorship, right? dictator-like, I guess you can call it. And that really turned me off the wrong way in terms of it was just crazy. Man, I just don't know. Honestly, I don't know. All right, we're catching a little bounce here, but I mean, Dow went negative. Now it's back to positive. S&Ps are bouncing a little bit here. Again, Powell's coming on in 10 minutes. It's a no trade for me. Are you guys trading right now? Pelosi Capital. Danny. I will say, I mean, this was a good setup. Like, if I was going to trade this was a very good setup. A lot of confirmations here. Obviously, we have some resistance here to break now. But, I mean, for the people that were getting really excited about the bounce, I mean, look at the trend here. So this blue line right here is the 10-day moving average I track. Kind of like, I pretty much use it to track the weekly momentum, day trading momentum, kind of see if I'm leaning bearish or bullish, right? And every single time we've had a pop, and even look at now. So here we had a pop up here above the 10-day. It held, but then it came back under. And then ever since this February 10th, every pop to the 10-day got rejected. We came up briefly with some consolidation here, a lot of inside day stacking, and then it got obliterated. Now today, this is very telling again here on March 11th, March 11th, we popped up to the 10-day, got rejected, stayed under. Today, today, because we had above the 10-day moving average, it was like 300 it was 300 points above the 10-day moving average today. Could have made a run to the 200-day moving average, or the 50-day moving average, which is this orange line, gold line here. I mean, this thing got, if we close below, I mean, that's gonna be an ugly, 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 ugly candle. Well, we're gonna know in 8 minutes. We're gonna know in 8 minutes. I know my voice sounds a little off today. We got, let's see. I mean, Baba's doing well, but that's a tough stock. VIX popped up. So VIX really exploded up here. I mean, it's still down 3% on the day, but that really, I'm not using VXX anymore because it's broken. How's VXX? Yeah, I'm not going to use VXX anymore because it's broken right now. But VIX is really popping. I mean, it was getting decimated. It's because people are really fed up with the way it is. But you can't put all your hope in one guy. Yeah, I get it, man. I mean, I think America works as a team effort. You know, it's the only way it works. That's the only way you work in any environment. Like if you work at a company, it's not one person; it's a team effort. If you're in the military, it's a team effort. If you play football or basketball, it's a team effort. It's just frustrating. SPY's getting hit pretty good right now. Apple's coming down. It's gonna get ugly, guys. Tomorrow should be a good day to trade. All right, Powell's coming on in 5 minutes. Let's just see what these charts are doing. Tesla, where you're at? Came down from its highs, 140. I mean, to be fair, Tesla's actually holding on. I mean, it could pop above. I mean, it doesn't look good. It could pop above the 200-day, but it's kind of fighting to get above it right now. Netflix. No comment. DraftKings from 74 down to 17. It hit a 14.97 low the other day. I like DraftKings too, you know. I mean, the big boys are holding. Amazon's not doing terrible. Microsoft's not doing terrible. Apple's not doing terrible. I mean, they're not like, you know, killing it, but I guess there's really nowhere for your money to go. Let's see what the banks. Goldman, not doing terrible. Invest in the banks, I guess, right? JP. I mean, JP Morgan's getting a little dicey. Bank of America. So it looks like GS and Bank of America are doing the best. Let's see our friend here. Boeing. Boeing's just been making lower high after lower high after lower high. About gaming. Win? Oh man, Win is cratered. Down 50%. Our boy Google's doing pretty well. Google's holding. But Facebook, bruh. Facebook. Or Meta, whatever they're called now. I mean, I think we knew things were going to get bad in October when they started rebranding and stuff. But I didn't think it was good. I mean, Facebook generates a lot of money. I just didn't think it was going to be this bad. But again, a lot of this stuff's artificial because I said the Fed has been buying left and right all 2021. But our boy Domino's. Domino's hit a high December 31st, 2021. Woo. That thing got smoked. Nvidia's not doing terrible. Got rejected at the 50-day moving average today, though. So that's not good. Man, what a move. What a move today on Nvidia. Straight up and now, straight back down where it started. That's the thing, like during a bear market, you're going to see massive rallies. Just be careful. Don't get sucked into going too long, you know. As long like I always say, as long as we're under the 200-day moving average, don't put all your eggs in one basket. I mean, I've seen traders be putting up big, like, oh, I think it's time to go long now. And I'm not saying it's not, you know. A lot of people are like, we get spikes like this, you say, I told you so. I mean, you know, if you profit from a move from 210 to 240 on Nvidia, congratulations and sell. Good. I'm happy for you. But like for me personally, I'm not trying to catch these bottoms. It's just not the easier trade right now. Cool Bean says, I've been noticing for a couple of days that finance stocks look like they're climbing. I haven't messed with them, not wanting to get stuck in a head fake. Why do you think that finance stocks have been going up a little bit? Because they're raising rates and they're going to be making more money. Banks be getting paid off of interest rates. You guys try these buys? Have you ever had one? It's pretty good. I don't get paid for this, by the way, but no sugar, and it's got caffeine. I'm addicted to caffeine, guys. Hate to say it. Man, we're just keep going lower here. Let's see what SPY's doing. SPY's at 426. Oh my gosh. Oh my gosh. It's freaking cratering. All right, SPY's red. Dow's red again. Nasdaq is fighting. But, I mean, all right, hold up.
I want to begin by acknowledging the tremendous hardship the Ukrainian people are suffering as a result of Russia's invasion.
Let me know if you guys
The
can hear
human
okay,
toll is tragic.
or if you want me
The
to turn up the
financial and
volume.
economic implications for the global economy and the U.S. economy are highly uncertain. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, in support of these goals, the FOMC raised its policy interest rate by 1/4 percentage point. The economy is very strong, and against the backdrop of an extremely tight labor market and high inflation, the committee anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we expect to begin reducing the size of our balance sheet at a coming meeting. Economic activity expanded at a robust 5.5% pace last year, reflecting progress on vaccinations and the reopening of the economy, fiscal and monetary policy support, and the healthy financial positions of households and businesses. The rapid spread of the Omicron variant led to some slowing in economic activity early this year, but cases have declined sharply since mid-January, and the slowdown seems to have been mild and brief. Although the invasion of Ukraine and related events represent a downside risk to the outlook for economic activity, FOMC participants continue to foresee solid growth. As shown in our summary of economic projections, the median projection for real GDP growth stands at 2.8% this year, 2.2% next year, and 2% in 2024. The labor market has continued to strengthen and is extremely tight. Over the first 2 months of the year, employment rose by more than 1 million jobs. In February, the unemployment rate hit a post-pandemic low of 3.8%, a bit below the median of committee participants' estimates of its longer-run normal level. The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. As a result, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. FOMC participants expect the labor market to remain strong, with the median projection for the unemployment rate declining to 3.5% by the end of this year and remaining near that level thereafter. Inflation remains well above our longer-run goal of 2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. These supply disruptions have been larger and longer lasting than anticipated, exacerbated by waves of the virus here and abroad, and price pressures have spread to a broader range of goods and services. Additionally, higher energy prices are driving up overall inflation. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine will put additional upward pressure on near-term inflation here at home. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We know that the best thing we can do to support a strong labor market is to promote along expansion, and that is only possible in an environment of price stability. As we emphasize in our policy statement, with appropriate firming in the stance of monetary policy, we expect inflation to return to 2% while the labor market remains strong. That said, inflation is likely to take longer to return to our price stability goal than previously expected. The median inflation projection of FOMC participants is 4.3% this year, and falls to 2.7% next year and 2.3% in 2024. This trajectory is notably higher than projected in December, and participants continue to see risks as weighted to the upside. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. Our policy has been adapting to the evolving economic environment, and it will continue to do so. As I noted, the committee raised the target range for the federal funds rate by 1/4 percentage point and anticipates that ongoing increases in the target range will be appropriate. The median projection for the appropriate level of the federal funds rate is 1.9% at the end of this year, a full percentage point higher than projected in December. Over the following 2 years, the median projection is 2.8%, somewhat higher than the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Reducing the size of our balance sheet will also play an important role in firming the stance of monetary policy. At our meeting that wrapped up today, the committee made good progress on a plan for reducing our securities holdings, and we expect to announce the beginning of balance sheet reduction at a coming meeting. In making decisions about interest rates and the balance sheet, we will be mindful of the broader context in markets and in the economy, and we will use our tools to support financial and macroeconomic stability. As we noted in our policy statement, the implications of Russia's invasion of Ukraine for the U.S. economy are highly uncertain. In addition to the direct effects from higher global oil and commodity prices, the invasion and related events may restrain economic activity abroad and further disrupt supply chains, which would create spillovers to the U.S. economy through trade and other channels. The volatility in the financial markets, particularly if sustained, could also act to tighten credit conditions and affect the real economy. Making appropriate monetary policy in this environment requires a recognition that the economy often evolves in unexpected ways. We will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain moment. We are attentive to the risks of potential further upward pressure on inflation and inflation expectations. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Let's go to Gina at the New York Times.
Hi, Chair Powell. Thank you so much for taking our questions. I wonder if you could detail your thinking a little bit about how you're considering the risks of going too fast and potentially tipping the economy into recession, and how you're weighing those risks against the possibility of going too slowly, allowing inflation to become embedded and kind of getting behind the curve.
Good question.
So I guess I would start by saying that in my view, the probability of a recession within the next year is not particularly elevated. And why do I say that? Aggregate demand is currently strong, and most forecasters expect it to remain so. If you look at the labor market, also very strong, conditions are tight, and payroll job growth is continuing at very high levels. Household and business balance sheets are strong. And so all signs are that this is a strong economy, indeed one that will be able to flourish, not to say withstand, but certainly flourish as well in the face of less accommodative monetary policy. So I guess that's how I would say I'm looking at that. Of course, the objective is to achieve price stability while also sustaining a strong labor market, and that is our overall objective. But we do feel the economy is very strong and well positioned to withstand tighter monetary policy.
Yeah, they printed $2 trillion in last year.
Thank you. Let's go to Howard at Reuters.
Hi, Chair Powell. I was wondering, in the SEPs, you have quite a markdown to GDP from 4 to 2.8%. I'm wondering, how much of that do you feel is a result of the Fed's stiffer than expected action here? You talk about monetary policy operating with a lag, but is this going to bite quicker than expected?
I don't think that's a big piece of it, actually. I think some of that is just an early assessment of the effects of spillovers from the war in Eastern Europe, which will hit our economy through a number of channels, highly uncertain. But you're looking at higher oil prices, higher commodity prices. It'll be so that we think that will weigh on GP to some extent. So that's part of what moved those assessments down. I think generally monetary policy works with a lag, so some of that would also be in there. But remember as well that 2.8% is still very strong growth. If we think that the potential growth rate of the economy is somewhere around 1.75%, 2.8% is strong economic growth. It would have been one of the strongest years, in fact, of the last expansion. So while it's lower than last year's 5.8%, it's still quite strong growth. So I would say it's quite a strong forecast.
So in that context, what would trigger you to go faster or slower on the rate hikes? Ongoing increases doesn't really tell us whether this is going to come in bigger chunks or evenly paced through the year.
Yeah, so the way we're thinking about this is that every meeting is a live meeting, and we're going to be looking at evolving conditions. And if we do conclude that it would be appropriate to move more quickly to remove accommodation, then we'll do so. I can't be perfectly specific about it, but that's certainly a possibility as we go through the year.
Thank you.
Thank you. Let's go to Rachel at the Washington Post.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. I'm curious if you can be specific on when you expect to see inflation will start to come down, especially with the combination of rates going up, fiscal aid dissipating from the economy, and supply chains getting better. And if you don't start to see that, how will you signal it? What will you be looking for, and what will you be looking for over the course of the year? Thank you.
So I guess I would say that before the invasion of Ukraine by Russia, so let's go back to that. I would have said that the expectation was that inflation would peak sometime in the first quarter, maybe the end of the first quarter of this year, and then maybe stay at that level or a little bit lower, and then start to come down in the back half of the year. So now we're already seeing a little bit of short-term upward pressure in inflation due to higher oil prices, not natural gas a little bit, but not so much for us since we have our own natural gas supply, other commodities prices. The other thing is that you're seeing supply chain issues around shipping and around lots of countries and companies and people not wanting to touch Russian goods. So that's going to be more tangled supply chains. So that could actually push out the relief we were expecting on supply chains generally. So I guess I would say that the expectation is still that inflation will begin to come down in the second half of the year. But if you look at where I read the SEP headline median, we still expect inflation to be high this year, lower than last year. And then we expect, though, particularly with the effects of the war, but also the data we've seen so far this year, we expect inflation to remain high through the middle of the year, begin to come down, and then come down more sharply next year.
Let's go to Nick at the Wall Street Journal.
Nick Timmeros of the Wall Street Journal. Chair Powell, over the last 6 months, the Fed has shifted its policy stance quite a bit. 6 months ago, you were still buying assets. Most officials weren't projecting any interest rate increases this year. And yet, despite the shift over the last 6 months, real rates are as negative today as they were then. So how concerned are you that further inflation surprises will offset the effects of recent policy firming by leading real rates to stay at levels that do not actually provide much restraint to the economy? Thanks.
So that's one of many ways of capturing the situation, which is that the committee really does understand that the time for rate increases and for shrinking the balance sheet has come. And I would just say, I would go back to the economy is very strong, as I mentioned, tremendous momentum in the labor market. We expect growth to continue. It's clearly time to raise interest rates and begin the balance sheet shrinkage. And I just wanted to say that as I looked around the table at today's meeting, I saw a committee that's acutely aware of the need to return the economy to price stability and determined to use our tools to do exactly that. You couched it in terms of real rates. I would say if you look at the SEP, you've got people getting close to or even above, in many cases, their estimate of the longer run neutral rate. So I understand that doesn't do it for real rates, but if you go out a year or two, many people are in their forecasts are having tight policy from a real interest rate standpoint. So that's something that we're focused on. Of course, it's a highly uncertain environment, and we don't know what's going to happen, but we do know that we're going to deploy our tools to achieve our goals, and that includes the price stability goal.
Let's go to Victoria at Politico.
Hi, Chair Powell. So looking at the summary of economic projections, you all have inflation coming down over the course of the year to 4.3%. And then you also have rates going up to what appears to still be below roughly what would be estimated to be the neutral rate, although I know that's a little bit uncertain. So I was just wondering, how much of inflation coming down do you see as actually being as a result of the Fed itself raising rates? And then also, if I could just ask, given that Sarah Bloom Raskin withdrew her nomination, what do you expect to do with the regulatory portfolio? Do you expect to assign a governor in charge of that?
Okay. So sorry, tell me again your first question.
My first question is, how much do you expect inflation to come down as a direct result of the Fed's actions?
Okay, so part of inflation coming down at the very beginning is clearly to do with factors other than our policy, and those would include potentially the supply chains getting a little bit better. Certainly base effects. You're lapping, as you know, when you look at a 12-month trailing window, you're lapping very high inflation in March, April, May, June of last year. So there should be some effects from that in the 12-month picture. Really, what we're looking for, though, is month-by-month inflation coming down, and so it's really it's all the things we've been talking about, that really haven't helped much, including the shift away from goods and back to services, including supply chains getting better, including labor force participation, all those things that have been sticky and not happening. But a big part of it is the base effects I mentioned as well. I think monetary policy starts to bite on inflation and on growth with a lag, of course. And so you would see that more in 23 and 24. But also remember, we started talking about rate increases last year. For some months now, the financial conditions have already incorporated a significant number of rate increases. So it doesn't start today. In effect, the moves are already priced into the market for a few months now. So so the clock is running on that, and I think some of that will be seen in the second half of the year as well. And on the regulatory portfolio, so I would just say this: we have an obligation to carry out under the law, in supervision and regulation, and we're doing that. That's what we're doing. The committee is not active, so what's happening is things are coming to the full board, and we're voting on them. We're getting our business done. We got the stress tests done. We've looked at a number of proposals for mergers and things like that. So we're working ahead. Of course, we don't have a vice chair for supervision, as you mentioned, but we're making do with the situation we have, and a good number of things have come straight to the board for approval.
Let's go to Neil Irwin at Axios. Let's go to Neil Irwin.
Hi, Chair Powell. It's Neil Irwin at Axios. Thanks for taking our questions. In the Statement of Economic Projections, we see a forecast of median 1.9% Fed fund rate at the end of the year, 2.8 end of next year. Wondered whether that aligns with your own expectations, in particular on that point of overshooting the long-term neutral rate, and also if you can tell us anything about how that might be paced, front-loaded, back-loaded, how high is the bar for doing 50 at one meeting?
So I don't, Neil. I've never talked about my own SCP projection. It's in there, but I think Fed chairs have generally not done that because we just haven't done it. It's because we have to put together the consensus on the committee and present that consensus. So I wouldn't talk about my individual one. And in terms of the pacing of it, I would just point out that there's 7 remaining meetings this year. This isn't something we discuss or debate or agree on, but there's 7 remaining meetings and there's 7 rate hikes. I would add there's also the shrinkage of the balance sheet, which people do the math different ways, but that might be the equivalent of another rate increase just from the runoff of the balance sheet. So I don't know. We haven't made any decisions on front end loading or going steadily through the year. And as I mentioned, if you look at the SEP, a good number of participants do see more than 7 rate increases this year. And I can't give you, I'm not going to try to give you a really specific test for what it would take to do that, but I will say this, though. We'll be looking at the data as they come in. We'll be looking to see whether the data show expected improvement on inflation. We'll be looking at the inflation outlook and making a judgment. And we'll be going, each meeting is a live meeting, and if we conclude that it would be appropriate to raise interest rates more quickly, then we'll do so.
All right, I think we got the gist of it. Looks like they're having technical issues over there. He's just standing there waiting. All right, we're gonna turn him off. So I guess, I mean, the consensus is like they're just kind of wait and see. They're gonna raise rates to 1.9% this year. QT is going to be happening, but they're discussing that at a future meeting, so they haven't let us know. I mean, quite a big bounce here on SPY, 5 points. VIX came way down. I mean, I guess we'll see how we close. I mean, because it's kind of violent. I mean, we were green, then we went red on the day. Now we're green on the day again. Like, we'll see. I mean, where are we at on the 10-day here? Okay, we're above, so that's good. It did test the 10-day, came down, bounced. So that's a good sign. Let's check Nasdaq here. Yeah, Nasdaq's looking pretty good. I mean, again, like what I want it to come up here to test the 50-day moving average. I mean, this double top right here, the 200-day moving average, that was rough. That was rough here back in February. Have not tested it again. But I guess we'll see what happens. I mean, if you guys like the stream, hit the like button. I'm going to take off. You guys have a great day. If you missed the rant at the beginning, this will be available for replay. You guys have a great day. As always, stay safe, stay green. It's us versus herd.